Welcome to the Financial Thought Exchange podcast, where you get to learn from the leading thinkers in finance. I'm your host, Lotta Moberg, and my guests today are Roger Ibbotson, Professor Emeritus of Finance at Yale School of Management, and he's also the chairman of Zebra Capital. And we also have Larry Siegel, who you know as my co-host here at the Financial Thought Exchange podcast. And he's also the Gary P. Brinson Director of Research Emeritus at the CFA Institute Research Foundation. Now, they are here as the men behind our latest publication, Exponential Wealth, Centuries of Stocks and Bond Returns. And in this project, Roger is the main author, whereas Larry is the executive editors. And in the publication, when you go through it, which we of course recommend that you do, you'll find several well-known and prolific thinkers in finance that contributed with really interesting chapters and a lot of interesting studies on the perspective of the topics that we're going to talk about today and much more. So welcome.
Great to be here. Yes. And I think I'll just mention the book. What started this whole thing was, of course, we're at the 50th anniversary of my original articles back in 1976. The first one measured the historical returns starting in 1926 for 50 years, but now we have 100 years of data. The second article we're celebrating is the simulations of the future, where we made forecasts for 50 years at that time, up to the year 2000, but we've also extended those forecasts now out to the year 2025 to see how they would have all worked, and it's all in the book. So these indices that they were known as stocks, bonds, bills, and inflation. Well, these indices got discontinued, and at this 100th anniversary, effectively, of everything, or 50th anniversary, we wanted to rebuild all these indices. And so all these indices have been rebuilt, and we've got 100 years of data on the U.S. Stock and bond markets. We also brought in a lot of different co-authors in order to look at markets before 1926, basically the centuries before that, and also bringing in the all the different global markets here. So the book is really a compendium of all the different types of markets we've had over the centuries, with special emphasis on the U.S. over the last 100 years. So we're really excited to talk about this book, and we're really excited to put all these data sets together, essentially.
Yeah, that's helpful. So you mentioned SBBI, so that's the stock, bond, bill, and inflation yearbooks that people may be very familiar with and know you for. So maybe we'll just, how does this project then connects to those yearbooks that people may have heard about?
Well, those yearbooks, the key thing, I guess, is those yearbooks have been discontinued. They no longer exist. In fact, um, and we have, and Morningstar hasn't really been producing the stocks, bonds, bills, and inflation data anymore. And that's what the impetus was here, to replace all this data and bring it back to life here, because it is the 50th anniversary when we first published it, as I said, and of course it's now we have a whole century of data. So it's really was the right time to write this book. And of course, once you write a book like this with all this data, it's good to go get all the rest of the data. A lot of these great co-authors who have worked on this field now, because now when we first did this 50 years ago, there really wasn't any data around. There were the Fisher and Laurie studies, but they hadn't updated them, and nobody really knew what these markets looked like. They didn't know how stocks compared to bonds. They didn't know how stocks really outperformed bonds a lot. They had no idea of exponential wealth, actually, and that's what the title of this book is. How money could grow so tremendously, really, over time, exponentially, by holding it over long periods of time.
And that's good for context. Maybe I can ask you, Larry, you as the editor and going through all of this and all the chapters and working with the authors, what was the most surprising thing, do you think? Or what was do you think that also our readers are gonna really find as a big takeaway from reading this?
Well, I think that there are two contrasting takeaways. One is how similar markets have been in the distant past in some ways, and in other countries in some ways. and the other is how different they are. For example, the US was the best performing market in the world over the last century. If you were to extrapolate US results to the whole world in the future, you'd get an awfully high estimate, and you'd probably be over optimistic. But you'd be pretty optimistic anyway, because the world market has grown at a very respectable rate that would have made long-term investors very wealthy if they were diversified among different countries, because sometimes a particular country doesn't do well. But it was interesting, especially to look back at previous centuries and see how, although market institutions and practices have changed, the basic idea of investing for future growth, which we call exponential growth, because that mathematically that's how it works, that hasn't changed at all.
What would you say in terms of, well, either one of you, are there some specific takeaways in terms of just, you look a lot at performance numbers. I remember there's the growth rate of 10%, inflation of 3%. And by the way, we'll focus here on the US numbers, even though, as you say, the publication itself has a lot of international components to it. Anyone wants to give a little bit of an overview there?
I think we could do this essentially in a chart, which we can show to the listeners here. The we're looking at the growth of a dollar over the last 100 years, and actually a dollar invested in just in large cap stocks grew to 14,751. I mean, this is almost 15,000 times over the 100 years. Of that is, you can see how wealth actually could get created. That number though is just a 10.1% return, essentially. 10.1 keeps on. Well, you probably most of us are familiar with the rule of 72, where you take 10 into 72, basically every 7 years or so, the stock market doubles. Now that when you go from 1 to 2 to 4 to 8 to 16, I mean, after 7 years, you get to 2, and after 14 years, you get to 4. But this really exponentially turns into a really amazingly huge number here, that 10%. That's what the graph shows, essentially, basically. It shows that graph, and it has the other series on it, the stock market, the bond market, the inflation on it. And it's all, by the way, in log terms, because in log terms, you have a measure of essentially the slope of the graph is the same as the return. And then, so you can look at any point in time over the last 100 years, look at that slope and see what the return was. And that's what exponential wealth is all about, basically doing this in log terms.
We should note that this is the US market, right?
Yeah, this is the
Not
US
like
market. It's a bit
international.
lower. The international returns were a bit lower, but they were still high.
Yeah.
And so, and by the way, when we did make forecasts, because we actually made forecasts here out to 2050 now, in the last chapter of the book, we actually used the international risk premiums instead of the U.S. in order to give a better estimate of it. But all these estimates, when we make forecasts like this, they're in probability distributions. They really essentially use what we call bootstrapping or Monte Carlo analysis. Eventually, we're drawing distributions, and so we're not saying this is the return you're going to get. We're saying that this is a whole distribution of the returns that you can get, but the distributions are mainly very positive with substantial numbers.
You don't have 14,000 times the purchasing power today that you would have had in 1926 by buying and holding the U.S. market. It's about 800 times, because inflation was about 20 to 1, and that brings down the real value of the number. But 800 times your money is a huge amount of money, and it does not in any way change the story that if you're a long-term investor, that you should do very well.
Yeah. How much did you say inflation was? Maybe we should repeat that number.
That was actually 2.9% over the whole period.
Yeah. So is it fair to say then that if we want to think of it as in real returns, we're talking about 7% has been kind of the real returns in the very long run in the US?
Yeah, that's roughly correct. basically getting, but still 7% after inflation is still a very big number. Yes.
But you're
Right.
doubling money every 10 years in real terms because
Yeah.
of
Yeah.
the
So
time you do
that's
it.
great to get back to. Roger mentioned the law of 72, and just the heuristic of calculating this. You take 72 divided by whatever that growth number is. So divided by 10, you get 7, but divided by 7 instead, right? Roughly, you instead get 10 years. So still pretty quickly that you can double your wealth if you're in the market. So maybe we should touch on that. Like, what does this even mean? Because I think it's very exciting to see, and I think a lot about, as an economist, about what does this mean for economic growth and all that. But you do emphasize this implication of, if you're actually invested in this market, that could increase your wealth a lot. How do we think about that when we're talking about 100 years? What does that even mean to be in the market for that long?
Well, it's probably difficult to actually um, be in anything like these are, by the way, there's no alpha here. There's no extra return. This is just being in the stock market, being in large cap stocks. But it wasn't so easy to have a diversified portfolio of large cap stocks and to reinvest your dividends um, over at least the first 50 years of the period. But when we did this back in 1976, that was just at the time when the index funds were coming out. And I can say I personally did invest in these index funds. Um, like Vanguard had index funds just coming out in roughly 1976 and so forth. And so they were starting to become available. And there were some other earlier indexes that actually I had worked on myself. Basically, I was at the University of Chicago at the time. And so these index funds were something that was available, I guess, for the last 50 years of the sample. It probably would have been difficult to actually invest in index funds in a broadly diversified portfolio in the first 50 years of this sample. But I think for the last 50 years, it's certainly something that was mostly achievable.
Well, for the next 50, it's very easy to invest in index funds.
Well, Roger mentioned that the 70s, so that's when it's available. But was it as cheap as, I mean, how much of a drag of performance would it have been in the 70s and 80s to invest in an index fund? I don't know what the charge was at the time.
Well, and right now it's like less than 10 basis points mostly, but then it might have been 25 or something. It wasn't a big. Index funds always were low priced, uh,
Hmm.
and and so and they usually in beginning stages, we didn't like if it was you're doing the S&P 500 index. We didn't invest in all 500 stocks. We invested we did some stratified sampling techniques that we invested in something that would very much resemble 500 stocks. So we had much more, but of course it became cheaper and cheaper and easier to invest over time. And so now you actually do invest in all the stocks.
So how would you guys imagine, when you look at these data, and we're starting to in the 1920s here and 30s and 40s, how would you imagine what kind of people might actually have access to the market? Or how would a person, let's say I am rich, I have connections, I'm all plugged in, maybe I work in the finance industry in that super early world, right? Like, how do they even stay in the market practically in the earlier part of this index, like 20s, 30s, 50s, 40s?
Well, you could buy and hold, of course, and
Mhm.
a lot of people did. The reinvesting of the dividends would be trickier to do, but you could definitely hold your positions. Actually, quite a few people got interested in the market in the 1920s, maybe too many, and and of course they had to live through the 30s. We're actually including this started not by accident. Actually, it had to do with the University of Chicago CRISP University Center for Research and Security Prices databases at the time. They started in 1926, and my study started in 1926. These were, by the way, done originally with Rex Singfield, and and it picked up that depression. So many people that you're talking about who had been so interested in the market and found it as a easy way to make money got really hurt dramatically in the 1930s. And then after that happened, it took a while to bring the retail crowd back into the market.
Right.
But if you stayed invested through the 1930s, you lived to participate in the huge bull markets after World War II and so on into the present. And the Depression, although it wiped many people out because they were leveraged or they were selling in order to raise money to live on, if you were able to hold the market through that period, you did extremely well anyway.
But what do you think also then? So if we think that's one aspect of it, is there are people that we can conceptually think about how they're actually in the market for a long time, and obviously not the same person in generations. What are the other ways of just thinking about such a long history that you collected here and constructed of returns? Like, what does this actually mean? Because I'm thinking that it also it says something about the development of markets, development of economies in general. Like, there is this profound growth of the companies are underlying this. Like, if we don't think about whether I as a person can put in an index, like, what do we learn from this series, and what seems to me to be also pretty consistent in a way when you take this bird's eye view of it, of returns that you actually get over time? Any thoughts around that?
Well, it is actually tied to the economy. I've done a lot of work over the years. I've been very interested in demand and supply, basically. And demand has to do with how much people will pay for something, how excited they get about something, how risk averse they might be, or much liquidity they need, things like that. And supply has to do with more what companies in the economy are supplying. Well, these things are all tied together. The kind of returns from the stock market match what the economy is supplying. I guess in both cases, you have to recognize, you think of GDP growth might being 3% a year or something like that. Well, that real GDP growth, but that's because we're consuming most of it. We're not reinvesting it, and and here with these total returns that we have here, we're actually doing these indices based on total returns, where you reinvest your income. They're not exactly matched because you have to adjust for the fact that if you're going to reinvest it versus if you're going to spend it, it's a whole different story. In the economy, we spend most of our product that we produce each year. In the stock market, we have been spending a big chunk of it through dividends over the years, but it's been shifting now because basically for tax reasons mostly. I think we buybacks have been replacing dividends. And so but people do take money out, of course. Well, even if it doesn't come in dividends, they take money out by selling their shares, essentially. So
That doesn't affect the indices. The fact that you may choose to consume some of your investment profits, that's the reason for investing in the first place. But the way to measure what the market has provided is to calculate the total return, including reinvestment of all dividends, back into the index, rather than making some sort of accommodation for what you might withdraw because somebody else might not withdraw. We're trying to see what the markets are offering, not what any particular investor would have achieved.
and it is a big confusion. Actually, what actually happened back in the late 60s, really, they started really first measuring total returns. They weren't even measuring total returns before that because they were saying, "Oh, this is what your capital gain is. This is how your values have increased, and this is what your income is." And they didn't add the two together. Really, that didn't happen until the late 60s. So one of the most important aspects of these studies that I did was I was doing it in total return form, and hardly anything had been measured in total return form prior to these studies. And even the index funds didn't start out having reinvestment programs. They added that later so you could have easy reinvestment programs.
I didn't know that. I first invested in the Vanguard 500 index fund in 1983. I had a windfall gain by crashing my car, and they gave me some money for the car, and I still have the shares that I bought in 1983, and they're worth about 100 times what I paid for them.
Of course, one of the reasons, like you said, Larry, that you invest is that you can get something out of it. At some point, you want to take something out. At the same time, if you never reinvested your dividends, I'm pretty sure that your total wealth of the world that would be invested in the stock market would shrink pretty rapidly, because the whole idea of we're growing, then people actually have more money. So if you always take out the money that you're getting in dividends, that might also create an imbalance, right? So we have kind of two sides of imbalance, right? Like, people might be familiar with the concept of there is earnings, right? A company produces something. Here's a pot of money. What do you do with that? Well, you often do one out of two things. Like, some of this money gets reinvested in the company, and that allows the company to grow. But you also have what's called like a payout ratio. Like, you can measure that over time. And if you didn't do that, you couldn't have a discount cash flow model of the company, and it would be worth nothing, right? So there's always that balance. And then on the other side, which you maybe Roger would call the demand side, like the people actually investing, they also have to make then a decision. And I don't know how those two mirror necessarily each other, but that's the next step of the decision. Out of these dividends you gave me, what am I then actually putting back in and saying, no, I actually think that should go back into the company.
So we're getting into what has been the confusion, and it still exists to a great extent, confusion. The dividend yield was actually 3.7% over this period. But when you take the two chunks out of this, and it's exponential. So when we talk about that exponential growth, it doesn't add like that. If you take out half the money and pay it out, you're not going to get half the money at the end, because it's going from doubling every say 7 years to doubling every 14 years leads to a totally different number at the end. Much lower number. Not going from 10% to 5% doesn't decrease your value at the end by half. It dramatically changes the value. So you get a lot of this exponential wealth effectively by staying in and getting the high number that actually includes the reinvestment. So it's critical that you actually keep the reinvestment in there in order to get these exponential wealth that we're talking about here.
I should mention, when you said some words there. So dividend yield, that's not the payout ratio. That's not the part of the earnings a company grows out. This is the price of a share, and then how much dividend per that share gets paid out. That's why that was such a lower number than our other examples there.
Yeah, so a small part, and by the way, the part that's being paid out is less and less and less. It was historically 3.7% of the yield on the large cap stocks. More recently, it's just a little over 1%, because, as I say, they're replacing this with buybacks. Companies are allowing people to buy out of their positions here, but basically they're buying it back essentially with their buybacks. So now they're paying out their cash by buying out shares instead of paying out dividends today. So the whole situation has changed. And one of the big things isn't always reinvestment; it's also taxes. I mean, there are fees, and there are implementation fees and things like that, costs. But at the retail level, anybody who's a taxable investor, that has a big impact on what your ultimate value is going to be. So how you're managing your taxes is probably the dominant feature now for retail investors, because how much they reinvest and how they manage their taxes, that determines to what extent they're getting this exponential wealth.
Fortunately, at least in the United States, a lot of people are able to invest tax deferred, so that the investment grows at the rates of return that are in this book until you take it out, basically until you retire or need the money for some other reason, and then you pay the tax once. And being able to pay the tax at the end like that improves the after-tax return for people who can participate in these plans, usually called 401k and IRAs, but there are others.
But is the tax environment in the aggregate generally, would you say, more beneficial now as a capital like investor, because of that, or because Roger said it's also more planning around it? So I was thinking maybe it's more like more taxes to worry about.
The tax rates used to be much higher, but they were also far more loopholes. But there are still a lot of loopholes. And so, yeah, people complain about the billionaires who are effectively not paying higher tax rates than most retail investors, effectively, because there are all kinds of there are ways to get around these taxes, basically, in different ways. And so, but one simple way to get around capital gains tax is to die, because there's a step up on your death. I mean, I'm not recommending that way
Great
necessarily.
advice.
I think I'm going to wait for that one. But yeah, the other is never sell anything.
Yes.
Yeah, if you don't sell a stock, you don't pay the capital gains tax. But most people invest, I believe, through various kinds of funds, either traditional mutual funds or ETFs, exchange traded funds, and they have their own way of subjecting you to taxes or avoiding taxes. I don't know if you want to mention that at all, Roger, but
Well, it would be a complicated subject to mention, but to get into, but basically ETAs have better tax characteristics. ETFs have better tax characteristics than mutual funds. And that's why that's one of the big reasons there's been a big shift from mutual funds to ETFs.
Pick your brain a little bit more on this dividend question. I'm thinking, if we think about, there's an underlying growth in the economy here, and this generates stuff that, I mean, companies are the ones producing it, obviously, and then they issue this, there's cash coming along and you can reinvest it and all that. Does that kind of mean that regardless of what they pay out in dividends, in the end, they really can't kind of affect the as long as everybody's an entrepreneurial and keep growing. If they pay out a lot in dividends, you could say, well, the economy is going to slow down because there's not a lot of capital to that is getting reinvested. But on the other hand, if people have more dividend than they kind of are preferring when they think about longer and shorter term consumption, they put them back into the company, so they land in the companies anyway. And the driver is actually on that kind of demand side of like, we're putting it back into the economy.
So
Any
we're
thoughts
at
on
these
that?
total returns because that's what corporations are really
Yeah.
creating for us here, basically, these total returns. On the other hand, it's not macro consistent. We can't all keep all the money and reinvest everything, because effectively, whether they're paying out dividends or buybacks or something, the the money is being paid out. So everybody can't be fully invested. Some people have the money ultimately is getting paid out of these corporations. So collectively, in aggregate, we are consuming effectively. We're measuring what the corporations are producing, but what the corporations are producing consists of something that sort of stays in the market and something that's paid out of the market. And therefore, when we say that we can create all this exponential wealth, that's for staying in the market. But each one of us basically takes money out in different ways. And so to the extent we take money out of the market, we become more like the overall economy and maybe growing 3% instead of this 10%. Yeah. Or actually it's 3% real, but instead of the 7 you talked about.
Well, it's interesting to think about in that context, though, in terms of how the capital bunch of capital that's sitting in these companies actually grow, right? Because as you say, they might not be issuing a lot. They might be actually net negative issuance, which is what we call buyback, like net buybacks. So, but on the other hand, if the value of this cluster of companies, let's think about these 500 companies in an index, actually increase, and people who may keep investing and having a bigger share of the economy invested if they so please. And what that means, well, it's not like we're running out of shares. It just means that they boosting up the prices, the demand curve, shifts outward, and you get higher prices for these stocks, which reveals, it's a price signal, right? That it's now more valuable what they're producing.
So when there's a buyback, there's less shares available then, because they're reducing their number of shares. The company are buying back their shares and reducing their number of shares. Of course, on the other side, some companies are going to issue shares. And so but with all the buybacks, it's not clear that we're issuing more shares than we're buying back, So so the number of shares overall may or may not be increasing. It depends on different years. Right now, but not right now, there's a big IPO market, effectively like with SpaceX and so forth going on. There's a lot of money being issued here. So you have both the buybacks on one side, where companies are buying back their shares, but you also have a huge new issue market coming out, where companies are issuing shares.
Right. I mean, there's two ways of thinking about the market, right? One is the number of shares, and then the other one is the number of just money that gets invested. And if one share is worth $1 versus $100, it's a big difference, right? So the wealth of that gets created can increase even if you're not increasing the amount of shares. That's
But the important thing from our perspective as
Mm.
as an index creator here is we're measuring the total return because each investor is going to take out different amounts of cash flow to consume. This total return is actually what the corporations are producing, these total returns in the equity part.
And I know that when you say that, everybody's going to get very curious about index construction and some of the methodology behind that you both have been working on. And this is actually the first out of two conversations. And in the second conversation, we will be covering that. So I really recommend that you click on that. If it hasn't been published yet, then keep looking out for it. Of course, you should be subscribed to our channel also to look out for that. I was just thinking maybe I could round this conversation up now with just the general question you would hit on a little bit, this connection between GDP and return. And we kind of are all thinking like economists here, there's a connection, like naturally. And of course, Roger, you've done so much work on this. If you would ask, I would say the average person who may not have read everything but what they heard, and certainly if you read Economist and such, you might learn that there is no connection, right? I'm curious, both of you, what you would say to people who would say, there's the paper by Ritter, I think in 2004, 5, around there, saying, well, I found no connection and stuff like that, looking at returns, GDP growth in different years. Where would you think that people might go wrong, if that's a misconception, or how do you think about that question?
Well, there is a connection that,
Yeah.
and actually the connection has been pretty tight. For the most part, the dividends have been the consumption, and yes, but equities are a more levered version of the economy. So as a more levered version, it outperforms a bit, but basically it's has this connection. But both the GDP, which most of it is consumed and not reinvested, and then there's the stock market where actually most of it is reinvested but not consumed, and ultimately though they kind of match each other long run. I've done studies where they match each other long run. After you adjust for what's consumed and what isn't consumed in the markets.
Yeah, they do. One reason why they might not look like they match each other all that closely is that the stock market is very noisy. Prices go all over the place. GDP growth is not particularly noisy. And so the timing of the gains in the stock market may not line up exactly on a year by year or quarter by quarter basis with the timing of GDP growth rate changes. And so you could write a paper saying that they're not related, but they're very closely related in the long run.
Thank you so much. Thank you so much for joining me for this conversation, to both of you. And thanks all for listening. So this was the first out of two conversations. Definitely, you should jump over to the next one right now. It's been posted. This is the Financial Thought Exchange podcast. I've been your host, Lotta Moberg. Our guests have been Larry Siegel and Roger Ibbotson, executive director and administrative author, respectively, of Exponential Wealth, which is our publication here from the CFA Institute Research Foundation. It's called Exponential Wealth, Centuries of Stock and Bond Returns. Make sure that you find this publication in the show notes, and subscribe, of course, to our podcast. And we will see you again in the next conversation. Thank you.
For more information, please visit rpc.cfainstitute.org/research-foundation.